what we're really excited about, life science and education. These are areas of the economy at a macro level that are super hot, but the problems around it are wicked and haven't been solved.
Welcome to the Opportunity Zones podcast. I'm Jimmy Atkinson. As many of my listeners know, most Opportunity Zone investment opportunities are real estate based, but operating business investment is certainly possible. One such firm working on utilizing the Opportunity Zone incentive for early stage venture capital investment is Spring Mountain Capital, and I'm pleased to be joined today by their vice president, Jack Januszewski. Jack joins us today from Midtown Manhattan. Jack, it's great to see you. Welcome to the show. How are you?
I'm great, Jimmy, and it's great to see you here. As I have said to you a couple of times, I've been a long-time listener and a first-time interviewer here. You were in this podcast, and this whole community has been instrumental in helping us, get an understanding of the OZ space back in the early innings when we were getting started. And I'm really thrilled to be here with you today.
Yeah, that's great to hear, Jack. Thanks for the kind words. Yeah, you and I guess you've been following OpportunityDb and listening to the Opportunity Zones podcast for several years now. So thanks for listening. And it's great to have you on the show. You and I first met in person just a couple months back at the beginning of November in Washington, D.C. at the Novogradac Opportunity Zone Summit. I love those in-person events. I hope we have some more of those in 2024 because they can be rather catalytic, getting to actually meet people in person. But with that said, Jack, let's turn our attention to the task at hand today. Let's get on with the interview here. And Jack, is as my audience of high net worth investors, advisors, other Opportunity Zone stakeholders, maybe they're familiar with Spring Mountain Capital. Some of them, for anyone who may be unfamiliar, can you briefly explain who is Spring Mountain Capital? What are you guys? And how does the firm operate within the Opportunity Zones industry?
Sure. Thanks, Jimmy. Like you said, I'm Jack Januszewski. I've been with Spring Mountain Capital since 2019. I first actually joined as a research intern, frankly, sort of looking into the OZs. It was a project of ours, just sort of academic, and it's well in line with the firm's ethos of sort of looking for unique special situations that result in potentially strategies for our clients. So to back up, Spring Mountain Capital was formed in 2001 by Lonnie Steffens and Greg Ho, basically two gentlemen that sort of attempted retirement and failed, and said, let's come up with a kind of a boutique sort of investment office and alternatives shop that developed a strategy around what the McKinsey Investment Office sort of initially pioneered around special situations. And the firm is in 5 different groups. We offer a range of products, up and down the risk curve, fixed income products, all the way to what we're doing, which is early stage venture capital. And each group kind of operates in their own little pod. And back in 2019, we sort of were probed by an investor, asked about Opportunity Zones. They said, hey, you're looking at this. What do you guys think about this? Incentives. This was pre-regs, the final regulations. And we were sort of curious about it. And we thought abstractly, given the fact that the firm doesn't do real estate investing, we said, well, is there a way to do this? Is there even a way to do what Spring Mountain has been doing in recent years, which is, technology investing in traditionally Series A startup companies? Could we do something here? And it resulted in us doing a lot of work around how we would possibly do it. Does it work in the regs? Is it feasible? How might we structure a fund that could do, kind of VC-like investing? And how we might be able to provide a differentiated offering on both a Opportunity Zone kind of context and also a venture capital context. And that resulted in the creation of what we call WIN internally, WHIN, which stands for West Harlem Innovation Network. As the name implies, we can get into a lot more detail of what the portfolio is kind of meant to look like and what our vision for community impact is. But we use the word network deliberately. We're trying to build a cohort of companies, early stage businesses that grow together in a community and feed off of one another based on the sectors they're focusing on, based on the people in there, and crucially, based on the mission of social impact that we have for these specific regions. This means hiring locally. This means developing job opportunities that have long-term, higher-paying propositions for these communities. So that's just a very high level. We can go into some other specifics around, for example, what sectors we look at and how we work with the community and other sorts of aspects. But I thought I'd just stop there and let you respond.
Yeah, that's great, Jack. And I do want to dive into what you're doing within that opportunity zone dynamic through the WIN, West Harlem Innovation Network, a little bit later in the program today. I want to get a quick introduction to you personally, though, Jack.
Sure.
Just briefly, what's your background? You said you mentioned that you arrived at Spring Mountain Capital in 2019, pre-final regs. The final regs were rolled out in December of that year, December of 2019, if memory serves correct. But what's your background and what's your role today at Spring Mountain Capital?
Yeah, thanks. My mom tells me I need to talk more about myself, but better about myself, but I don't like this sort of thing. But I started before working at Spring Mountain. I was at a startup technology company, an ed tech company, education, based in Philadelphia. And I was the first hire and focused on basically mathematics education, after school math remediation for first generation to college students. That was really motivating to me. I have a very deep passion for the education space, which is one of our sectors, which we can get into. And I bring a lot of the kind of startup ethos and kind of frankly lived experience to the venture side of the office now. It's often the case that the kind of pipeline for allocators is, you go work at an investment bank and then you spin out to a kind of private equity or a venture capital firm, and that's how it is in many cases. And we at WIN aren't really like that. A lot of our team, actually, frankly, everyone on the team has more operational experience than explicit investment banking experience. The firm Spring Mountain, we have a ton of resources internally and expertise on deal structuring, on fund organization, all this other stuff. But to really make early stage work, we really feel a need to get into the weeds and with our companies and work directly with them. And we have found, especially with early stage and social impact, that empathy is deeply important for this. And so having gone through, startup land, we feel we're better at both identifying opportunities, identifying founder fit with an opportunity. Founder market fit is almost as, if not more important than product market fit in many cases. And also sort of, like I said, having that empathy to understand what it's really like to run these startup companies. It's a lot of stress, and having that operational capacity is both good for the business and good for the interaction with the team, and ideally, good for our investors as a result. So it's sort of a risk mitigation strategy. But anyway, that's more on how we're thinking about it. I come from that world of startups and have a deep passion for other entrepreneurs that are in these spaces trying to change the world. And I'm deeply, motivated by my lived experience and who I'm working with on a daily basis.
Good. And now you're leveraging the opportunity zone incentive to drive investment into early stage companies, those founder-driven companies that it seems like you're very passionate about, Jack. And again, it's not totally unique, but it's very rare that I talk to someone who's using the opportunity zones incentive as a way to attract capital, equity investment specifically, into operating businesses and venture capital. There's a couple of other groups around the country doing it, but I was really pleased to meet you, Jack, and learn more about Spring Mountain Capital, because there really aren't a lot doing it. And I oftentimes wonder why there aren't more. But anyways, talk a little bit about that. How exactly are you utilizing opportunity zones to drive equity investment into early stage companies right now?
Yeah, thanks, Jimmy. It's the real question here, in my opinion. And frankly, my goal for those who are listening, here is to inform, remind in some cases, that this is possible, and that the real, one of the spirit of the law, behind the original legislation, which I think Cory Booker has done a good job of kind of enunciating over the years, and several others as well, is to have a broad-based sort of holistic economic development across all axes, right? Not simply real estate, not simply one thing. And we just take the approach that we have the expertise in the business side, and we want to focus on that versus the exclusively real estate kind of methodology. And we basically have a sort of vision for a community where if you develop these businesses that are in higher paying jobs, developing technology roles that are more risk mitigated. If you have something like a pandemic, it's not necessarily frontline workers. You have feasibility for remote work. You have higher paying roles in these technology enabled businesses. You'll raise the tide of a whole community versus simply allocating into a mixed use development or something of this sort. It's not a knock against it. It's just a differentiated approach in terms of the OZ context. We are proud to be kind of part of the few and the proud on the business side, and we're well aware of the complexities. You said there's some hesitation around this, and it's justified. I like to joke that people have feet. And buildings don't. If you're in a place for 10 years, how do you get a business to stay there? How do you ensure that your investors will get that benefit if you're dealing with humans instead of assets, real assets? We have a lot of thoughts around this. We have a lot of technical structuring that we do around, for risk mitigation purposes, ensuring that we remain compliant. And if such as we don't, we have ways of resolving it. But we also primarily, first and foremost, focus on, like I said earlier, that founder fit, where these businesses, in addition to passing all of the criteria that they would traditionally have to in a VC context, that they would need to get an investment from Spring Mountain normally, which means market, product, team, everything that you can imagine that a venture investment would require. We have an additional strata, a matrix that they need to meet with that is simply around mission alignment, right? They need to believe in our vision for economic development, for equity, for including diverse voices in your team, and driving social impact. And that's a huge piece of our due diligence when we look at these businesses.
So give me some examples now. It all sounds great, but I'd like to hear a couple of concrete examples. Which sectors specifically are you in? And then maybe you can give one or two case studies of some actual portfolio companies that you have invested in.
Sure. Yeah, and I'll do a quick thing on the strategy itself as well, 'cause it's related. But we focus on, we spend a lot of time thinking about sectors. I view this as a real privilege, frankly. The OZ timeline of 10 years to get the big kahuna at the end is, we were given the chance to think in a decade. A lot of VC firms are on the flywheel, where you get the fund, you allocate, you raise the next one. And you kind of dupe the strategy, or you tweak it, you know what I mean, and you rely on your past performance, which doesn't indicate future results, but it seems to work that way. We said, what are 10-year problems? What are really ambitious, big, hairy, audacious goals in specific sectors that we have knowledge of and expertise in, and we could allocate into, but we're excited about solving? Broadly speaking, we focus on businesses that are developing for-profit solutions, business solutions to the disproportionate health, educational, and socioeconomic outcomes in historically disenfranchised or marginalized communities and geographies. So that's a lot of buzzwords. You know what I mean? What does that really mean? This means that we're focusing on life science investing, education investing, and technology businesses that we call portfolio amplifiers, businesses that accrete to the development of the portfolio, basically business B2B SaaS type products, and other amplifiers, which one of my examples will be. And we also have a strategy focusing on food and beverage, which is orthogonal to these other things. But what this is meant to be is a comprehensive strategy, an ecosystem, to use a buzzword, where we have different types of businesses floating around in the same environment that have different points of entry for people up and down a skills chain, right? You have a life science business that is high tech, PhD driven, tinkering with a product, right? But when you scale, you're producing a chip, a microfluidic chip, right? And that chip can be produced there, in an opportunity zone, in a light manufacturing context. And folks that have been working in the community as in a bakery can come in, get some training from potentially one of our education companies, and upskill themselves into producing microfluidic chips. My boss, Greg, has this funny little tidbit that he likes to say. Is where you can brew beer, you get $1 for a pint. If you brew a biologic, you get $100,000 for a pint. That's not exactly the numbers, but the idea is you're doing the same type of work with different inputs, and you're producing a product that has much more value, economic value for that geography, while being paid more for doing that work. So that's a amorphous example, but that's a business that we invested in. The business is Atlas Exomics. They started out in our office, literally incubated internally, and they are now running on full cylinders. I can't get into so many specifics, but they're doing various grants with the Fed on several different fronts, Cancer Moonshot and other kinds of very impressive projects. They've developed a microfluidics chip that is running very advanced multi-omic analyses. It's like very technical genomics work that is, at the end of the day, to belittle my friends at Atlas intensely, a chip. They're making a chip and selling a chip and services around it. And as we scale, we expect that business to employ tons of folks. Whereas you could invest in an Instagram in a VC context and have a great performance. It's a fabulous way to invest and to be an investor in. We thought that we should build businesses that are, broadly speaking, bigger, that have more employees and impact the community in a more holistic manner. So that's one concrete example in the form of a real business that is in the portfolio that's in line with our strategy for community development. One other one that I'll give, and I'll stop rambling here, is a portfolio amplifier business. We struggled internally with hiring folks, hiring people at our firm and in our businesses, right? Finding the right talent. And so we incubated a recruitment firm called Authority, which focuses on historically overlooked types of candidates, right? They go where other people don't. They don't use traditional resume heuristics. They're a white glove kind of recruiting service that's using technology to holistically assess a candidate's capacities, right? So it's a tech-enabled recruiting firm that we built for our own purposes. And now that business is not only servicing other businesses around the country, but our own portfolio as well, right? It's meant to be a kind of holistic ecosystem where businesses are helping and feeding on one another. And so that's just another example of something in the portfolio that's in that portfolio amplifier wing.
That's great. Those are two great examples, Jack. Thank you. I love the pint analogy. Pint of beer for $1, a pint of biologic for, honestly, like $100,000 for a pint of biologics might sound cheap to me.
Yeah,
but
I was going to say I missed a zero, I think.
Yeah, might miss 1 or 2 zeros there. That's a lot of biologics. Anyway, Well, those two portfolio companies, great examples. Is everything you're doing located in West Harlem, or do you
That's
do
a great
any
question.
investment outside of that area?
Yeah, so we focused on Harlem for a couple of reasons, which I'll get into in a minute. But the short answer to your question is no. You know, we invest in other geographies as well.
Okay.
The legislation enables this. That company, Atlas, that I mentioned, is actually spun out of technology out of Yale. One of the things which we could potentially get into more detail later on is, you know, a lot of these life science businesses are spun out of university research parks that happen to be in opportunity zones. And our model, especially with early stage, is designed to incubate businesses as well as invest in a more traditional sense in established companies. And so we have an outpost in New Haven for life science specifically, due to our relationships at Yale and other folks up there. But Harlem was chosen for many reasons. The kind of obvious one is we're here in New York, and we really want to be involved in the day-to-day here, which is core to our strategy, being deeply involved with businesses. We can circle back to that point later, but the question that we were often asked when we were building this in the first year, mid-pandemic, by the way, was why Harlem? You know, why here versus another place? And you know, over time, the question became where else but this place, right? Harlem is a deeply special region. Historically, culturally, it has a very deep impact on the world, frankly. And we are of the belief, maybe it's Sinatra, maybe it's the New York chutzpah that we've got here, but if we can make it here, we can make it anywhere. The goal of this model is do it right here in Harlem, in New York, and scale this model, announce to the world that this is possible, and scale it across the country to the Harlems of the world, as our community partners up there like to say. But there should be, you know, a Finn in Philadelphia, you know, a Din in Detroit. You know, it's badly named. We haven't really figured out the naming convention, but there should be this model spread across the country in OZs around the U.S. You know, that was the original intent, I think, of the law. As I said earlier, the spirit of the law. So a little bit about Harlem there.
I don't mind the name. I think you can bring a Fwin to Fort Worth here, down in Fort Worth, Texas, where I am. No, this is great. Great background on what you guys are building within the startup world, these investments in these particular types of early stage venture capital companies. Couple of examples you've given already. Just shifting gears a little bit, I'm curious, how are they structured for the purposes of an opportunity zone equity investment? Talk to me a little bit about how you've structured all these portfolio companies, where the fund sits, the qualified opportunity fund, and how, if I'm an investor with capital gains, I can come in and participate as an equity investor.
Yeah, thanks, Jimmy. So the fund itself, you know, Win runs an opportunity, Spring Mountain, I should say, manages an opportunity zone fund under the Win brand. This functions and structured and files as a QOF. You know, this is a single entity that you know, does its assets test just like everybody else that listens to this podcast. It follows all the traditional bells and whistles. The difference is that we take capital that comes in and push it into QOZBs, right? And all of these startups are qualified opportunity zone businesses when they receive our investment, either through, you know, the realities on the ground or through the various safe harbors that exist. And we, as part of our diligence, do a lot of work on that OZ compliance stuff as well. A lot of it is an uphill battle, you know, getting a business, you know, a group of people that don't know much about this to understand that we are structured in this way, and you need to be based here, or you need to be working this much in this place, or, and getting everyone to understand it. It goes back to my point earlier around mission alignment, right? I'll go back to structure, I promise, but the teams need to be aligned with what we are restricted by, to put it maybe cynically, right? Or a negative light, and believe in it, right? That they're going to help us help the community by being there and following the rules of the road that we set out. On a technical level, we mitigate this through the deal docs that we work with the businesses, right? Where we, in writing, in ink, say you will be a QOZB, right? And that's the deal. And to take it or leave it. You want the money, you got to be this. And that can be a sticking point in the discussions with any business. Generally speaking, startups want the capital, and they're willing to work with you based on what standards you have. But we have various kind of levers to pull in order to get us as a fund, comfortable with the risks associated with it being a QOZB. Then when it comes to compliance, we have internally, an engine around ensuring and verifying and memorializing compliance as a QOZB on the 6-month intervals that we're required to. And it's extra work, no doubt, but it's work that we're happy to do because of what we're trying to accomplish.
And the structure overall, is it one qualified opportunity fund that essentially holds a broad multi-asset portfolio of multiple QOZBs?
Correct.
I guess one QOZB for each startup. Is that right?
Yes, that's correct.
Okay.
Forgive me for not being more clear with that. It's one QOF that has cash for stock in several QOZBs, and it's basically like any old venture capital fund. It just happens to be a QOF, and we worry about the compliance. We try and take that risk off of the portfolio companies as much as possible. And like I said, bake in the rules of the road as much as we can.
Good. So if I don't know, if I'm a family office or an ultra wealthy investor, or maybe I'm just one of your run of the mill high net worth investors, maybe I trigger a gain in my stock portfolio. I sell some real estate, or it doesn't matter. I trigger some sort of gain, right?
Yep.
And I have a couple of options. The one option is I can just cut you a check essentially and be an LP investor in your multi-asset portfolio holding
Correct.
QOF. I'm curious though, if I've already formed my own captive QOF and I'm deal sourcing, I cannot go directly into your QOF because the current regulations prohibit that. But is there a way for me to invest alongside your QOF if I like one or two or more of your portfolio companies? Can I kind of kick the tires on those, and ultimately can my captive QOF invest directly into the QOZB? Do you assist with that?
Yeah, part of the thank you, Jimmy. Part of the like I said at the top, one of the goals of this conversation with you, for me, is the lightning rod of innovation for OZs itself, right? Indicating that this is a differentiated OZ strategy and it can be done. So all of the businesses are QOZBs. Such as they have investment rounds available. Any old investor, even if it's Bob down the street that happens to have $100,000 in gains and likes what these guys are working on, they could set up a captive fund and do it that way. At the end of the day, the QOZB on their cap table, they don't care, right? They're going to do what they're going to do. It's just a name, right? And if that entity happens to be a QOF, then all right, bully for them. The businesses, we can opine on this at the end. At the end of the day, the businesses don't benefit from this incentive as much as
correct.
That's just to say, it is something that in terms of the lightning rod accessing the portfolio can be done. One thing that we're working on internally And I can't get into so much detail immediately, given that it's a real kind of real-time situation, is a co-investment vehicle that does exactly what you're talking about, where rather than Joe down the street who already has a QOF set up and is looking for a deal, someone just had a gain event and they don't know what to do with it, right? And in that case, we as a firm, rather than the parent fund, can set up a single purpose vehicle or a captive fund, as whatever you want to, whatever language you want to put on it, for specific investments in specific QOZBs or a range of them, such as those rounds are available in the portfolio.
No, that's pretty cool. Yeah, I've heard a lot of different terms: sidecar deal,
Yeah,
sidecar
special
arrangement,
purpose. Yeah,
special purpose vehicle, captive QOF, but essentially allowing for an investor to go directly into a QOZB. No, that's all great. Yeah, so a lot of different ways to participate. And yeah, one thing you mentioned is the businesses don't directly benefit from the OZ tax incentive. There's no tax incentive for the portfolio companies. The way that they benefit is this is a differentiator in terms of raising
yeah,
equity, because they can tout the fact that, hey,
yeah.
I have this great startup company. You may already be interested in investing in me. Just, I mean, think of like a pitch that any startup might give to anyone, or think of Shark Tank, right?
Yeah,
Go on that show and pitch a great product that needs some investment. But on top of that, I offer you, the investor, these amazing tax benefits through this federally designated program called Opportunity Zone
yeah.
investing. So essentially, it's a way to attract more equity in a
Agreed.
startup, right?
I was referring more, I totally agree with you. And it's definitely an it factor for a lot of these types of businesses. And a lot of startups, I'm shocked, when I tell people about this and they're like, oh, I'm a, like, they don't know that they're based in a zone, and that, you know what I mean, that they already are. And more people need to be made aware of this fact, for the exact reason you're talking about, can attract more capital. I was more speaking to the tax gains themselves. I mean, like, if you're a founder of one of these
Exactly.
startups, you don't get the OZ benefits, as by owning this company, right? And uh,
Unless you inject your own capital gains into the
correct,
startup
correct,
formation of
correct,
the
correct.
business. And I'm hopeful that I'm sure there are some founders out there who maybe they sold the previous business and they're rolling over
Yes.
some of that gain into the formation of a new startup. So in that case, yes. But otherwise, yeah, if you're just a startup founder and you're not putting any of your own gains dollars in, which is probably the case most of the time,
Yeah.
you're absolutely right. There's no direct tax benefit to them.
It's one thing I think it should be discussed in the space. I think that it's something that, that and, accredited investor kind of, more holistic reform of how we think about community benefit, in this space. How do you give access to the OZs when inherently the legislation is written around capital gains? Who has capital gains, right? We're talking about a specific cohort of people in our country, and generally speaking, it's not the folks that are living in the zones already. Generally speaking, in broad generalities, but we need to think about this as an industry. It's something I hope is discussed more.
Correct. Well, I think that is a long-term goal for the
Yeah.
opportunity zone industry. Short-term goal, legislatively speaking, is to get the incentive extended by at least an additional 2 years,
Yep.
and put on some other reforms around transparency and reporting. I've talked at length about that pending legislation. Beyond that, once that extension legislation gets passed, fingers crossed, there is this idea developing in the industry of an opportunity zones 2.0.
Mhm.
And one of the pieces of that would include the ability to exclude capital gains, not just from capital gains dollars that are invested, but also ordinary dollars that are invested. Because
Right.
as you mentioned, Jack, the folks that have capital gains are probably the wealthiest 10% of the people who live in this country,
Correct.
by and large, accredited investors, basically, which is roughly about 10% of the households in the US qualify as accredited investors. That brings me to my next question, somewhat related. Who are your investors at Spring Mountain Capital typically?
Yeah. So again, I won't go into super specifics, but broadly
Sure.
speaking, WIN is structured in such a way that because we're effectively operating under a traditional, this is the parent fund, WIN, the main single asset.
And again, that's
CP.
just to clarify, that's WHIN, and it stands for West Harlem Innovation Network. WIN.
Correct. Yeah.
Yeah,
Thank you.
that's all right.
Broadly speaking, we focus on cohorts of investors that obviously, as we were just alluding to, have a large amount of capital gains in a semi-frequent sort of way. These are the high frequency trading firms. These are the kind of institutional LP types. Because one of the things that we struggled with originally were the exact problem that we just discussed, where people have a gain that's acute and very precise. I just sold my business for XYZ dollars. What do I do with it? And a lot of folks were unwilling to sign up for a capital commitment, where it's a 5-year commitment period and capital calls every twice a year. That's unorthodox in the OZ space, from what I've seen, given the kind of time horizon and nature of how the industry works. So generally speaking, we're focused on the kind of institutional types, the ultra high net worths, the folks that either have line of sight on a relatively set cadence of gains, or an ambivalence, towards whether or not the aggregate commitment is all gains or not, so that's we can take both. We're structured in that way. So they just won't get the benefits of the aggregate commitment. And then the others is, frankly, per our mission, which I said at the beginning, of focusing on businesses that are mitigating the disproportionate impact, social, socioeconomic, educational, and health outcomes in these communities. We're talking and about socially impacted minded investors, people that are motivated by our mission and believe in what we're trying to do. So folks that are focused on impact, we don't say the 3-letter word anymore with environmental, social, and governance, but the folks that are motivated by our mission to impact the community. So several different cohorts, generally speaking, the ultra high net worth types that have a kind of set cadence.
That's great. We're kind of winding down on time here. You mentioned something a little bit earlier. I wanted to turn our attention back to the what you're doing in New Haven, Connecticut, your network there, and this concept of spinning early stage startup businesses out of university parks, oftentimes, by the way, which happen to be located in opportunity zones. I actually had Brian Darmody of the AURP on this show many years ago. I'll try to link to that episode in the show notes for today's episode. I know you recently talked with him, but could you go into some more detail on that concept and how you may be rolling that out within Spring Mountain Capital?
Thanks, Jimmy. We've spent a lot of the time here talking about how our strategy is sort of differentiated in the OZ context.
Mm-hmm.
The thing that we're differentiated in terms of how we think about early stage is we deploy a model. It's kind of emerging. I encourage your listeners to kind of look into it. It's called the studio model. It goes by different names. There's Foundry, there's startup labs. There's all sorts of different names.
Incubator, accelerator, are those terms?
No, yeah. So incubators, accelerators are in that sort of that chain.
Okay.
Studios like to kind of differentiate themselves from incubator, accelerator. It's meant to be a kind of an augmentation of it, a kind of super accelerator, where you are directly partnering, in some cases, founding the businesses yourself, right? You have a kind of set strategy, and businesses are being spun out of a factory, a foundry, as they're sometimes called, started by a
Got it.
studio, right? You're
Got it.
working together to solve a problem, and it results in the creation of a business. The example I gave earlier of Athari is enigmatic of this, right? Where we internally were working on how to solve a human capital problem, and it resulted in the formation of a business. The good thing with that strategy, right, is multifaceted, but early stage investing involves an immense amount of risk, right? Always. And what we're trying to do with the studio model, both with our team, which I mentioned earlier in terms of operators and our sectors and strategy, is really get into the weeds with these founders, really work with them to drive their businesses forward. Where that touches life science is really exciting, both for the 2 points that we talked about earlier in terms of the scalability of this model, and where we can locate these strategies. A lot of university parks, research parks, a lot of universities, frankly, the kind of flagship spots that are spinning out IP in a life science context are based in OZs. I'd like to think that every governor was thinking of our strategy and how we're going to commercialize intellectual property and build businesses that are representative of the communities they're based in when they pick these zones. I just don't think that's what happened. I think that it was more luck than anything. But the idea is that if you're a founder or a scientist at a university, the commercialization of your technology is great, but if you are to do it, it will take you out of the loop, right? Often, right? You got to quit your teaching job to go run this business. And our thinking with this is, let us handle the business stuff, right? Let us spin out these businesses, base them right near you. You can visit, you can go work in your lab and keep teaching while still being involved. And the company benefits from place-based synergies of being affiliated and nearby that university park. And this is a model that we've deployed in New Haven with that business Atlas Exomics that I mentioned earlier, and can and intend to do the same thing all around the country one day. West Harlem is based, deliberately near some of the great university systems in New York City. City College is right on the hill with us, and Columbia is right at the bottom. So that's kind of the long-term plan around intellectual property and basing it in the communities. It's synergistic. It's there. It's in the community. You get to hire locally. You get to do your impact that you want to do. And the university benefits, they get to kind of reference it, in their own kind of collateral and say it's right down the street. It's a virtuous cycle around business development in a life science context.
That's a great concept. I love it. Hopefully this is one of those concepts that continues to get built out more and more, particularly if opportunity zones get extended, give the industry a little bit more time to get their arms around that concept. I think it makes a lot of sense to work with university research parks to spin out qualified opportunity zone businesses.
Absolutely.
We're running low on time, as I mentioned a minute ago. Just a couple more questions for you, though, Jack. Just to zoom out, I'm wondering if there are any broader trends, either in opportunity zones or venture capital investing, that you're keeping an eye on, that you want to comment on, any broader trends that you see playing out over the next 3 to 5 years?
Sure. Yeah. I was thinking about this before the call, and trends in OZs and trends in VC, they're kind of different beasts. We're hoping for the pending legislation to go through, and this OZ 2.0, those are two things I think that the whole industry, all operators, everyone listening, we all need to follow Jimmy's lead and let him lead us into the future of OZs 2.0, I think. But I think that there's a lot of great, robust discussion on this, and keeping this, extending this, and letting it gestate and grow and actually drive the impact is essential. And I think that short-sightedness on this can result in not effective outcomes. So we're in support of that. On the VC side, everyone loves talking about AI. We're looking at it too. Everyone seems to be. What we're really excited about is have been since we started, actually before the Gen AI kind of craze started, is around data, and particularly the personalization of health and the personalization of education. And this is why, we're focusing on those two sectors, life science and education. These are areas of the economy at a macro level that are super hot, but the problems around it are wicked and haven't been solved. We think that patient capital deployed through a structure like ours is actually quite well suited for these longer term problems around neurodegenerative diseases, personalizing education through the use of data and personalized health data around specific disease sets. You need to have a long-term approach in order to solve these types of problems. So we're really focused on data internally and those specific sectors, those specific problems.
Awesome. Well, Jack, thanks so much for sharing your insights today. One final question for you before I cut you loose. If we have anybody in the audience, any investors who might want to learn more about Win or Spring Mountain Capital, where can they go to learn more about you and your firm?
Sure. Thanks, Jimmy. The website is springmountaincapital.com. Win also, we have a little separate website as well, which is westharleminnovationnetwork.com. You can also type in WHIN.NYC and it will take you to the website, which is nice and pithy. And my contact information, I'm happy to share it with you, Jimmy, for the show notes. We're happy to speak with anybody, both companies that are looking for investment, investors that have questions on how we work, whatever works. I'm thrilled to be on this podcast, as I mentioned, and like I said at the very top, really want to spread the word about how this model can serve as a real lightning rod, for both community-based economic development across the country, but also the OZ space specifically. I will be super happy if everybody copies, the model, if it results in, economic development in these communities.
Perfect. Well, that's great. Jack, I will make sure to link to all those resources on the show notes page, which will be available, as always, on our website at OpportunityDB.com/podcast. I'll have links to all the resources that Jack and I discussed on today's show. And please be sure to subscribe to us on YouTube or your favorite podcast listening platform to always get the latest episodes. Jack, again, thank you so much for joining me today. It's been a pleasure.
Thank you, Jimmy. Thanks for having me.